People need to realize like ultra low rates is not a good sign of the economy, right? I'm sticking with Scotia economics. The call at Scotia is we're at 2.25 with the overnight lending rate. It's at the bottom end of the so-called neutral range. If your economy is healthy, you're not in a recession type of thing, 2.25 is kind of the bottom end. So we don't see any further rate cuts from the Bank of Canada. The call is for Bank of Canada overnight lending rate to actually start to go up later in 2026. The reason for that is inflation. The belief is that inflation is already around 3%, yet the Bank of Canada has done 2 rate cuts. That illustrates the trickiness of the environment right now with, the big 3 things are, inflation, unemployment, and GDP, right? Those are the things to watch.
Yeah.
They kind of move in different directions, but when you get slow GDP and inflation at the same time, which is kind of where we are being brought on by tariffs to some extent, right? Then you get that really tricky situation of, do I lower interest rates even though inflation's not where I want it to be if you're the central bank, for example, right? So, I think that's the view of our economics team is that rates are going to start to go up next year. And that would be a healthy scenario, actually. If they were to go down, it would be a sign that things are not going well, right?
Yeah.
People need to realize like ultra low rates is not a good sign of the economy, right? So yeah, I think that's the outlook for rates.